Last Friday evening, President Trump made a prediction so bold that it stopped financial analysts in their tracks. He stated publicly and unambiguously that the stock market will double within 3 years. Not a hope, not a suggestion, a prediction. And if you're an investor, a retiree with a 401k, or someone who simply wants to understand where the American economy is heading, you need to hear what happened next, because the implications reach far beyond a single tweet. The Dow Jones Industrial Average just crossed 50,000 for the first time in history. Champagne corks popped on trading floors. Financial media ran celebratory segments. President Trump himself took to Truth Social multiple times that day, writing at 1:47 p.m., "The Dow Jones Industrial Average just hit 50,000 for the first time in history. Congratulations, America." But that wasn't the end of it. 2.5 hours later, another post appeared, this one with a political edge. He wrote that experts claimed hitting 50,000 by the end of his term would constitute a great job, but he'd done it 3 years ahead of schedule. Then came the warning, remember this for the midterms because the Democrats will crash the economy. And then the third post, the one that matters most, the one where Trump pivoted from celebration to prophecy. He wrote that record stock markets and national security are being driven by great tariffs, and then declared, "I am predicting 100,000 on the Dow by the end of my term." Remember, Trump was right about everything. He ended with a pointed message to the Supreme Court telling them he hoped they were watching. Now, let's pause here. Why would the President of the United States address the Supreme Court in a post about stock market predictions? That detail is not incidental. It's the thread that unravels the entire strategy. The Supreme Court is currently weighing whether Trump's tariffs, enacted without congressional approval under the International Emergency Economic Powers Act, are constitutional. If the court rules against him, those tariffs get reversed. The revenue collected gets reimbursed. And a cornerstone of Trump's economic narrative collapses. So when he says, "I hope the Supreme Court is watching," he's not making small talk. He's sending a signal. The stock market's performance is now a political weapon, and he's daring the judiciary to disrupt it. But let's get to the math, because predictions are entertaining, but numbers don't lie. For the Dow to double from 50,000 to 100,000 in 3 years, it would need to grow approximately 26% per year, every year for 3 consecutive years. Is that realistic? Let's look at the data. I pulled up a 40-year chart of the Dow Jones. Over 4 decades, we've seen explosive bull runs, devastating crashes, recoveries, technological revolutions, financial crises, and everything in between. Now zoom in to the last 5 years. In that window, the Dow has climbed 59%. That's impressive. That's a strong market, but it's not 26% annual growth. It's not even close to the sustained velocity Trump is predicting. So I went deeper. I examined the Dow's performance over the past 10 years, year by year, and here's what I found. Not a single year met or exceeded 26% growth. A few came close. There were some strong years, but none hit the threshold required to make Trump's prediction a reality under normal conditions. Does that mean it's impossible? No. History is full of outlier events. Markets can surprise us, but it does mean that for Trump's forecast to come true, something fundamental has to change. And that something is monetary policy. Here's where the story gets interesting, because while Trump cannot personally control whether Apple's earnings beat expectations or whether consumer spending stays strong, he absolutely can influence the entity that has the most direct impact on stock prices, the Federal Reserve. And he just did. In May, a new Federal Reserve chair takes office, not by accident, not by random selection, by Trump's nomination. His name is Kevin Warsh. Now, if you've been reading mainstream financial headlines, you've probably seen Warsh described as hawkish. The narrative goes like this: Warsh is tough on inflation. He'll raise rates. He'll tighten monetary policy. He's the opposite of what Trump wants. But I want you to consider an alternative interpretation, one rooted not in what pundits say, but in what Trump does. Trump despises the current Fed chair, Jerome Powell. He's criticized him publicly, repeatedly, and even initiated a criminal investigation as a demonstration of power. Why? Because Powell hasn't lowered interest rates as much or as fast as Trump wanted. Trump views Powell as an obstacle. So ask yourself, why would Trump replace an obstacle with someone who will do the same thing or worse? It doesn't make sense. Trump has one of the most important appointments of his presidency in front of him, and the midterm elections are around the corner. The economy's performance, and specifically the stock market's performance, will determine his party's political future. Does it seem even remotely plausible that he would nominate someone who will sabotage that goal? Or is it more likely that the hawkish label is narrative cover and Warsh will ultimately do exactly what Trump needs him to do? Let me take you back to a moment 2 weeks ago. Trump was speaking at the World Economic Forum in Davos, and in one remarkable clip, he laid out his entire philosophy about how the stock market should work. He said that it used to be simple. When the United States had a great quarter, when earnings were strong, when economic news was good, stocks went up. That's how it's supposed to work. But now, he complained, when good news comes out, the market crashes. Why? Because the Federal Reserve panics about inflation and raises interest rates. He specifically called out Powell. He called him stupid for raising rates and stopping the country from being successful. Then Trump said the part that matters most. That's the way it's going to be. We've got to do that again because that's the way it should be. Did you catch that? Not, that's the way it might be. Not, I hope that's the way it is. He said, that's the way it's going to be. That is a statement of intent. That is a president telling you in plain language that he intends to engineer a market environment where good economic news drives stock prices up and the Federal Reserve will not stand in the way. And this brings us to an uncomfortable truth that most people don't want to acknowledge. We do not live in a free market. We live in a centrally planned economy. The stock market does not rise and fall purely on the strength of corporate earnings or consumer demand. It rises and falls based on monetary policy. It rises and falls based on what the Federal Reserve does with interest rates and its balance sheet. And if you don't believe me, let me give you one example that should shatter any illusions. In 2020, the United States experienced negative GDP growth. Unemployment skyrocketed. Businesses shuttered. We were in the grip of a pandemic. And yet, the stock market went up 16%. How? Not because the economy was thriving. Because the Federal Reserve flooded the financial system with liquidity. They printed money. They slashed interest rates to zero. They bought assets. They propped up the market, and the market responded exactly as intended. That's not a free market. That's intervention. That's central planning. So when Trump says the stock market is going to double, he's not making a forecast based on organic economic growth. He's making a promise based on control. He's telling you that he has the tools, he has the personnel, and he has the political will to make it happen. The question is whether you believe the Federal Reserve under a Trump-nominated chair will act independently, or whether it will act in alignment with the administration's goals. Now let's game out the scenarios. Scenario 1. Warsh takes office and does exactly what the hawks predict. He raises rates. He tightens policy. He shrinks the Fed's balance sheet. What happens? The stock market crashes. The economy slows. Credit tightens. And then what? Does Trump just accept that? Does he shrug and say, well, that's the free market? No. In that scenario, the Federal Reserve will declare an emergency. They'll cut rates dramatically. They'll restart quantitative easing. They'll flood the system with money again. And what does that create? Inflation. An asset price inflation, which means stocks go up. Maybe not immediately. Maybe there's short-term pain, but in the long run, the trajectory is the same. Up. Scenario 2. Warsh takes office and pivots. He talks tough but acts dovish. Rates stay low. The balance sheet stays large. Liquidity remains ample. Stocks continue climbing. No crash, just a steady policy-supported rally toward Trump's 100,000 target. Either way, the path leads to the same place. Because the system is built to support asset prices, the political incentives align with market growth, and the tools exist to make it happen. The only variable is timing and the amount of volatility we experience along the way. But here's what you need to understand as an individual investor, even if stocks go up in the long run, and I believe they will, because financial asset inflation is baked into the structure of our monetary system. They will not go up in a straight line. There will be corrections, there will be pullbacks, there may even be a crash. And if you are over leveraged, if you're using margin to buy more stocks than you can afford, you can get wiped out even if you're ultimately right about the direction. I've seen it happen to smart people. I've seen it happen to people who understood the macro picture but got caught in the volatility. Greed and leverage are a dangerous combination. So what should you do? If you're a long-term investor, stay invested. Understand that volatility is part of the game. Understand that central banks will do everything in their power to support markets because political survival depends on it. But also understand that the ride will be bumpy. Avoid excessive margin, manage your risk, and don't let short-term moves shake you out of long-term positions. Let's talk about what this means practically. If you believe, as I do, that the stock market's trajectory over the next 3 years will be heavily influenced by Federal Reserve policy, then your investment strategy strategy needs to account for that reality. It's not just about picking good companies anymore. It's about understanding the liquidity environment. It's about understanding when the Fed is accommodating growth and when it's restricting it. And it's about positioning yourself to benefit from asset inflation without exposing yourself to catastrophic downside risk. For conservative investors, that might mean broad index funds, something like the S&P 500 or the Dow itself. So you're capturing overall market beta without taking on individual stock risk. For more aggressive investors, it might mean sectors that benefit most from loose monetary policy, technology, growth stocks, assets that thrive in low-rate environments. And for the risk-averse, it might mean a barbell strategy, some exposure to equities for growth, some exposure to hard assets or inflation hedges for protection. But regardless of your specific allocation, the key principle is this: don't fight the Fed. If the Federal Reserve is going to support markets, you want to be positioned to benefit. And if Trump's prediction is even halfway accurate, we're looking at one of the strongest multi-year rallies in modern history. Yes, there will be bumps. Yes, there will be headlines that scare you, but the structural forces are aligned for growth. Now, I want to address the elephant in the room. What if I'm wrong? What if Warsh really is independent? What if the Supreme Court strikes down the tariffs and Trump's economic narrative falls apart? What if inflation roars back and forces the Fed to tighten regardless of political pressure? Those are legitimate questions, and the honest answer is that no one knows the future with certainty. Markets are complex, adaptive systems, black swan events happen, geopolitical shocks happen, pandemics happen. But here's what I do know. Over the last century, every time the market has faced a major crisis, the policy response has been the same. Print money, cut rates, support asset prices. It happened in 2008. It happened in 2020. It will happen again, because the alternative, allowing a deflationary collapse, allowing widespread bankruptcies, allowing the financial system to implode, is politically unacceptable. So while I can't guarantee Trump's 100,000 Dow prediction will come true on his exact timeline, I can say with high confidence that the long-term direction is up, because the incentives point that way, because the tools exist to make it happen, and because no administration, regardless of party, can afford to let markets collapse on their watch. Let me bring this back to where we started. Trump didn't just make a casual comment about the stock market. He made a public, high-stakes prediction. He tied his political legacy to a specific number. He replaced the Federal Reserve chair to give himself maximum influence over monetary policy. And he warned the Supreme Court not to interfere. This is not a passive forecast. This is an active strategy. And if you understand that, you can position yourself accordingly. The Dow hit 50,000. That's a milestone. That's historic. But it's also just the beginning of a story that's going to play out over the next 3 years. A story about power, about policy, about the intersection of politics and markets. A story where the protagonists are not CEOs or entrepreneurs, but central bankers and elected officials. And a story where the stakes are not just financial, but existential. For an administration, for a political party, and for millions of Americans whose retirement savings depend on what happens next. So here's my final thought. Whether you love Trump or hate him, whether you think his prediction is genius or delusion, whether you believe in free markets or central planning, none of that changes the reality of the situation. The president has made his intentions clear. The Federal Reserve will soon be under new leadership, and the trajectory of the stock market over the next 3 years will be determined not by earnings reports or economic fundamentals, but by policy decisions made in Washington. If you're invested, stay invested. If you're on the sidelines, consider whether this is the moment to get in. If you're over-leveraged, de-risk. And if you're not paying attention, start. Because the next 3 years are going to be unlike anything we've seen in recent memory. The stakes are enormous, the potential gains are staggering, and the risk of being caught unprepared is very, very real. The Dow is at 50,000 today. Will it be at 100,000 in 3 years? I don't have a crystal ball, but I do have data, I have historical precedent, and I have an understanding of how power works in a centrally planned economy. And based on all of that, I'll say this: don't bet against a president who's willing to use every tool at his disposal to make the stock market his report card. Don't bet against a Federal Reserve that's been engineered to support asset prices. And don't bet against a system that has spent the last 50 years proving that when push comes to shove, the printers turn on and markets go up. That's the reality we're living in. That's the game being played. And the only question left is whether you're positioned to win or whether you're going to watch from the sidelines while history unfolds. Stay invested, stay informed, and whatever you do, don't let fear or ideology blind you to the opportunity in front of you. Because ready or not, the next chapter of this market story is about to be written, and it's going to be one for the history books.